Good afternoon, everyone. My name is Aline Shuramoff, and I'm Senior Vice President of the Community Development and Engagement Division here at the Federal Reserve Bank of Minneapolis. And I'm pleased to welcome all of you to our virtual convening centered on an important but underappreciated provision of the unemployment insurance system known as shared work or short-time compensation. We have an excellent group of speakers today with intimate knowledge of shared work and new analysis to discuss. But first, I need to give our standard disclaimers that the views expressed here are the speakers and not necessarily those of the Minneapolis Fed or the Federal Reserve System. Before we talk about shared work, let me just remind everyone the core elements of unemployment insurance, or UI. Regular UI, as many of you know, replaces some of a worker's lost wages after a layoff. The program has eligibility restrictions for the individual based on previous earnings, the reason for separation, and job search requirements. It's only available for a certain number of weeks. The maximum number of weeks depends in part on the state in which the worker applied. And the program is largely funded by taxes on employers and is a joint federal-state program. So federal law sets guidelines that states must follow, but each state administers its own program. Now let's turn to the topic of today's conversation, the shared work, or otherwise known as short-time compensation, or STC. It's part of the broader UI system, but operates differently than regular UI in some important ways. Rather than supporting workers in the aftermath of a layoff, shared work serves as an alternative to layoffs. When participating in shared work, an employee would still get paid by their employer for a reduced number of hours worked, but they also receive prorated unemployment benefits from the state to offset that reduction in their hours. This contrast between traditional UI and shared work is represented, I think, quite nicely by this visual on this slide. This can be really positive for both employers and employees because it helps maintain their relationship during a temporary downturn and then step right back into full employment or full-time arrangement when demand returns. Employers get to avoid the cost of a layoff and the cost of rehiring and training, and employees get to keep their jobs. We saw this a fair amount during the pandemic. I heard a lot about it in the state of Minnesota at that time, that this was a really useful tool for many employers to maintain that important relationship. So how does this all work? To use the shared work program, employers need to apply at their UI state office. And the visual on the right here is what the shared work application looks like in the state of Minnesota. The application describes the plan, includes a list of employees that would potentially work those reduced hours. And then the employees are then paid by the employer for the hours they work, and then by the unemployment insurance agency for the portion of their reduced hours. Currently, a bit more than half of the US states have operational programs represented by the map on this slide. So you'll see Michigan, Minnesota, and Wisconsin, all states that are represented in the Federal Reserve's 9th district have programs in place. So that's basically half of the 9th district states. Here at the Minneapolis Fed, if you're wondering, we have a couple of key interests in examining shared work. First, it aligns well with the Federal Reserve's dual mandate to promote maximum employment and stable prices. It also aligns with the mission of the Minneapolis Fed's Community Development Engagement Team, the team that I lead here in Minneapolis, to provide leaders with research and data as they seek to understand outcomes for workers, particularly low and moderate income workers. So in today's event, we'll learn more about state experiences with shared work, specifically the data and leaders' experiences, both of which we very rarely hear about. I became interested in this issue in 2020, in spring of 2020, and during the pandemic, as I mentioned earlier. I really wanted to know and understand more about STC and all of the states in the 9th district and understand how employers were potentially using the program, but it was really difficult to get data to have a more comprehensive understanding. I learned that many UI agencies don't have programs set up. At that time, I think there was only about 25 programs, and now we're up to 30. And they didn't have the capacity at that particular moment amidst really high caseloads and changing federal laws. I think people might have been interested, but they were like, we can't really manage that in this particular moment because there were so many high cases in the beginning of the pandemic of unemployment cases. So now that we're not operating in a state of crisis, this is actually a great time to carefully discuss and weigh STC options. We're so fortunate today to have experts from Michigan, California, and Minnesota to present and add their important data and insight to this understudied program. So we have Dr. Leonidas Maremba from the State of Michigan's Unemployment Insurance Agency will start us off with a presentation on new data and analysis from Michigan. He'll be followed by Professor Till von Wachter from the California Policy Lab and the UCLA Economics Department, showing how the story is similar and different in California. And last but not least, our own UI Director, Jim Hegman from Minnesota Department of Employment and Economic Development, will share some thoughts from his years of experience with shared work in the state. I'm really looking forward to learning more from all of these experts today, and I want to thank you all for spending your time with us. Without further ado, I'll hand it over to our Assistant Vice President, Ryan Nunn, who leads our applied research group here in community development.
Great. Thank you, Aline. I'm really eager to get to our speakers' remarks. So without further ado, I'll just say welcome to Dr. Leonidas Maremja of the Michigan Unemployment Insurance Agency. He will kick us off with all new analysis of Michigan's WorkShare program. So whenever you're ready, Leo, please take it away.
Yeah, thank you, Ryan. Today, I would like to provide a comparative analysis of the use of WorkShare and regular UI programs in Michigan. So I would like to provide a comprehensive analysis of the characteristics of the participants of WorkShare or short-time compensation program in Michigan, including employers and claimants. And here are the questions that I wanna answer. What is WorkShare? I think Arlene just provided great details of that, but I will repeat a little bit. Who participates in WorkShare? How do WorkShare employers and claimants differ from regular UI participants? Fact number one is that our program in Michigan is pretty young compared, for example, to the California's program that started in 1978. Ours was established in March of 2015. So with the plan, eligible employees work a reduced number of hours in the work week and receive a portion of weekly employment benefits. So employers must meet certain requirements to be eligible, including having a current UI taxes, a positive reserve balance, and employee wages for at least 12 of the previous quarters. And beginning in July next year, Michigan hours reduction percentage will be 10 to 60%, which is a recent policy change from 15 to 45% reduction. So for example, if an employer selects 30% reduction, the employee on the plan will continue to work with a 30% reduction in wages and hours, compensated by 30% of the claimant's weekly benefit amounts. Next slide. Fact number two, in Michigan, the program saves jobs, which is what we want. So when applying for WorkShare, employers in Michigan report how many employees will be affected by reduced hours and estimate how many will be laid off without the program. Our statistics show that since 2015, Michigan WorkShare program has helped employers retain over 140,000 workers who may have otherwise faced layoffs. Employer estimate suggests the program prevented more than 99,000 full-time job losses. In 2020 alone, over 77,000 100,000 layoffs were averted at the height of the pandemic. Next slide. Fact number 3, employers' use of the program has been rising since the pandemic. Looking at the chart to the left, one can see that work-share plan counts remain above pre-pandemic levels, with consistent use for moderate hours reduction between 25% and 35%. Then the table to the right shows that from 2020 to 2024, work-share claims nearly tripled, driven largely by medium-sized employers. This trend highlights growing reliance on work-share as a layoff avoidance tool among larger firms. 3 out of 4 employers using the program have fewer than 51 employees, but most claimants come from larger employers. First, we see that on the left, the chart on the left, the small employers, those with fewer than 51 employees, make up roughly 3/4 of all participants in both programs, regular and work-share. However, on the right, the chart shows that work-share sees more employees from medium and large firms. And this suggests that while small businesses dominate both UI programs in Michigan, work-share may be marginally more appealing or accessible to larger firms. Fact 5 is that the average total wages in work-share has surpassed the regular program. So the chart on the left shows that when we look at the average number of employees per firm size, we see a notable difference. Work-share employers report significantly fewer employees in the medium and large categories. For example, work-share firms average around 1,600 employees, while large regular UI employers average over 3,400 employees. This could reflect program targeting, industry mix, or varying usage patterns. However, in chart 2 on the right, we observe strong wage growth among work-share employers over the last 3 years. Average total wages increased from approximately 2.9 million in 2022 to nearly 6 million in 2024. In contrast, you can see that total wages for regular UI employers remained relatively flat at around $5.2 million. This upward trend in work-share group could indicate growing engagement from higher wage or larger scale employers in recent years. Almost half of work-share employers are in manufacturing. Here we can see what industry favor using work-share. From 2022 to 2024, manufacturing alone accounted for nearly 50% of all participating employers, despite representing just 11% of regular UI employers. Other sectors like professional services, retail, and education, and healthcare had thousands of regular UI employers, but very few using Workshare. It is important to note that the number of employers participating in a certain program does not necessarily reflect the actual number of employees enrolled into the programs. We'll talk about this in a minute. So over 80% of Workshare participating claimants this time work in manufacturing. So this chart shows that most of both regular and Workshare claiming employees are in manufacturing. However, only 23% of regular UI claimants are in manufacturing, while this industry accounts for over 80% of all Workshare claimants. Next slide. The majority of Workshare claimants are white men. Okay, so the majority of both regular and Workshare claimants in Michigan are men, though with a larger percentage of 64.4% in Workshare. This is likely attributable to the large number of Workshare claimants in manufacturing, which is dominated by men. Observing the distribution of claimant race and ethnicity, there are significant differences between those in regular program and those in Workshare. White claimants make up almost exactly half of regular claimants, but this portion jumps to 77% of Workshare claimants. In contrast, the percentage of Black claimants drops by nearly 20% percentage points between regular and Workshare programs. Fact number 9 is that a larger percentage of Workshare claimants lack higher education. So next slide. So based on claimants' education levels, the majority of Workshare claimants have either a high school degree or did not provide details. In contrast, most regular claimants have either a high school degree or a bachelor's degree. Regular claimants skew left in terms of younger age categories, whereas Workshare claimants featured a more balanced distribution, skewed somewhat toward older age categories. Fact number 10 is that Workshare claimants tend to have higher wages. Claimants in the Workshare program have higher wages than their counterparts in regular program. Unlike some in the regular program, no Workshare claimants experience denial based on lack of wages. Higher wages could indicate company employees who are more valuable to their employers, such as specialized labor or management positions. The claimants with a zero wage listed are denied claimed due to lack of wages.
Well, thank you very much, Leo. That was fascinating and a kind of rare look at the the inner workings of the program. Now I'd like to turn things over to Professor Till von Wachter, who is a professor in the UCLA Economics Department and a faculty director of the California Policy Lab. And he and his team have some really fascinating new research on California's short-time compensation program that he is now going to tell you about. So please take it away, Till.
Thank you very much, Ryan. It's a great pleasure to be here, and this was a great presentation from Michigan. You can think of the work from California partly continuing that research, as you can see in a second. I've spent much of my career documenting the long-term adverse effects of job loss on workers, and so I'm very happy to be here to talk about a program that can prevent such long-term losses. Besides being a professor at UCLA, I'm also trying to move my slides here. Here we go. I'm also the faculty director of the California Policy Lab, which is a research institute at UCLA and UC Berkeley that cooperates with California government agencies to use their data for, to help them improve their programs. And what you see today is a part of a long-term cooperation between California's Labor Market Information Office. And what we mainly have access to is data on workers. So it's quite complementary to what you just saw. And you all now know that short-term compensation is a program through which employers can prevent layoffs and retain their workers and save hiring costs. And one detail I'd like to point out that employers, at least in California, are required, and I think in other states, required to keep paying health insurance and pension benefits in full to the workers on the program. And of course, they have to be the ones who apply to the program. So there's some additional cost to employer relative to the regular UI program. And another thing to know is that there is actually very little research on the outcomes of workers and firms participating in the program. From the United States, almost everything we know about how workers and firms on work sharing or short-time compensation fare is from European studies. Now, it is well known that short-time compensation is not a program that is very much utilized, even in the states that have the program. And certainly utilization is much, much lower than in many other, industrialized countries. And even though short-time compensation, the use of short-time compensation tends to rise in recessions, it remains usually a small fraction of total UI claims. And it's surprising given the benefits of the program. And there are a few standards explanations of the lack of take-up. And often we think that employers don't know about the program. There's a concern that these programs are typically small and maybe understaffed, and hence it's difficult to scale these programs up. In recessions, then, of course, firms face some administrative burdens and the cost of paying full-time job benefits. But another reason why short-time compensation isn't used as much in the United States is that the UI system itself offers alternatives to employers to maintain some attachment to their workers. And one such way is so-called partial unemployment insurance benefits. And partial unemployment insurance works in the following, in that a worker whose hours were reduced or who may have been laid off and then takes up another job, but at lower hours, right, can get prorated unemployment insurance benefits while they're looking for a full-time job. Right? So here, this is essentially the same outcome as under short-term compensation, only that the firm doesn't have the burden of applying or doesn't have to pay benefits. And of course, temporary layoff is still a frequent phenomenon in the sense that firms can let their workers go. They apply for regular UI, and then workers can be rehired, right? And especially, so there's these two other modes, partial UI and full UI plus recall, that a firm can use without having the burden of applying and paying benefits, and still may get to retain their workers in the end. And of course, during the pandemic, there were other ways that employers could, retain their employers, such as the PPP program, something that I'll come back to at the end. Now, what we're going to do, right? We asked the question, how do workers who are on short-time compensation fare compared to those who instead took up partial UI or full UI? Now, in an ideal world, to look at the impact of a program, we have a randomized experiment in which we send some workers that whose firms is thinking about layoff to short-time compensation, and some workers to say partial UI, or some workers to full UI. Now, that is actually quite hard to do. And so today, what you're going to be seeing is mainly a comparison of the outcome before, during, and after the shock, so the layoff or the participation in the program, for these three groups of workers: short-time compensation, partial UI, and full UI. And I'll talk to you about that in detail. And what we exploit is that we have information on which workers participate in the UI program as a whole, and then in particular, whether they receive partial UI, full UI, or short-time compensation. And for these workers, we can construct longitudinal earnings histories based on quarterly wage records. And then we have some information on their employers. And again, we cooperate with California's LMI office, so we have embedded employees through which we can access this data, and we don't have all of the UI data that, for example, you just saw from Leo's talk, which is very fascinating. And just to have a connection to the Michigan results, I'll talk briefly about some work we've done on which firms are using the short-time compensation program in California. And then I'll spend most of my remaining time describing how workers fare in these three different modes, right? Short-time compensation, partial UI, and full UI. I'll talk about the Great Recession, but I'll mention results from the pandemic as well. Now, here's a figure that shows you what's the industry breakdown among claimants that received short-time compensation in California in two crises. One was the Great Recession in orange, and the other is the COVID-19 pandemic in blue. And as is the case in Michigan, the majority of claimants before the pandemic and during the pandemic came from the manufacturing sector. And they were, to a larger degree, male, and to a lesser, and came on average from larger employers. So there's certainly a parallel here. What happened during the pandemic was interesting, is that there, as you can see, there's a substantially smaller share of claimants from manufacturing, even though it still dominates. And there's an increase in the use of short-time compensation by some of those sectors particularly affected by the pandemic, such as healthcare and social assistance, or administrative support and waste management, to some degree, arts, entertainment, recreation. I mean, you can go through the list. So there was a shift in which industries take up on short-time compensation. And that goes to show that if employers are interested and are being informed, right, they are more likely to take up benefits. We also took a deep dive into seeing which region and which neighborhoods are more likely to use short-time compensation. And it's clear that those higher income neighborhoods and neighborhoods that are better connected to broadband and have sort of a higher share of white workers are more likely to take up short-time compensation. So I'm going to pivot from talking about take-up, who uses the program, to thinking about how workers fare on short-time compensation. I'm going to show you several pictures that look like this, which I'll call an event study. And the event here at time zero, where the red vertical line is the entry into the UI program, and you see three lines that are for the three different sort of modes, so to speak. The green line is for those on short time compensation, and then the blue line is for those on partial UI, and then the orange line is for those who receive full UI. And on the horizontal axis, you see the quarters from the start of their benefit years. And we start 7 quarters before and follow them up to 4 years after the event. And perhaps the most familiar pattern is the orange line, is that, well, if you are laid off and go on UI, you have a prolonged, and in this case, a permanently lower, you have lower employment, right? And that can be even lower, 4 years afterwards. So layoff is an incredible shock to workers, both on their employment and their earnings. And now if you then compare that to the green line, these are workers on short-time compensation. Well, by design, their hours decline somewhat as they are on the program, but their employment rates remains high, and then there's a natural departure from their firm, so employment declines a little bit, and then likely a few years down the line when the program ends, there's a dip that you see, but by and large, right, these workers have pretty stable employment rates and then see a decline once the program ends. And then it's interesting to compare them to the blue line, which are those on partial UI. Again, these people are working, and the way as soon as somebody has positive earnings here, they are counted as employed, and so their employment rates also remains quite high and declines slowly over time as these workers sort of are working their way through the recession. And neither of these have these drastic employment declines as regular UI claimants have. Partly how these two, the green and blue line, is set up. Now, if you look at the next picture, it gets a bit more interesting. We show you the log quarterly earnings. So these are only workers that have positive employment, that have positive wages, and we look at their quarterly earnings. And you can see that, of course, the upper green line are workers on short-time compensation, and they work in manufacturing, and manufacturing workers typically have higher wages. And so, as in Michigan, right, workers on short-time compensation tend to have higher wages than your average UI claimant. There's a temporary decline as these workers are receiving short-time compensation, their hours are reduced. But if you take sort of the longer view, 1, 2, 3, 4 years out, wages are roughly stable, maybe a slight decline throughout the recession, which is not particularly surprising. And that stands in sharp contrast to the experience of workers on a full or partial UI, where you can see as soon as they start receiving UI, their earnings upon reemployment are substantially lower. And then you see a very common recovery pattern in that workers take about 4 or 5 or sometimes even more years to recover their earnings. And in particular, if you take into account that people who are not laid off have some earnings growth, these recovery patterns take much longer. And of course, you might say, well, yes, workers on short-time compensation fare better, but they come from a different sector, from different firms, and they're likely higher skilled workers, and so they would have fared better anyways. And so what we do in our research, we spend a lot of time to try to do an apples to apples comparison. And as far as we can tell, right, these benefits from short-time compensation are upheld, right? But of course, this is not a randomized experiment, so one has to take sort of the interpretation with a grain of salt. But it's clear here that those on short-time compensation don't suffer the same type of shock that those on partial and full UI suffer. Now, two additional outcomes we looked at really quickly is whether short-time compensation stabilizes attachment to the current employer, and it's very clear that it does in the sense that the probability of leaving the prior employer is much higher, of staying at the prior employer, excuse me, is much higher for those on short-term compensation, somewhat lower for those on partial UI, and much lower for those on full UI. And the same is true, right? The probability of switching industry is much lower for those on short-term compensation than for those on full UI, and partial UI is somewhat in between. Let me wrap up. We find that the typical worker on short-time compensation fared better than those on partial UI or full UI. And so there's real hope that this program, bears substantial promise for laid off workers, and we believe there's substantial scope for raising participation. And what is really worth considering is to subsidize firm participation. So, for example, states have the ability to not experience rate employers that participate in short-time compensation, and that's really worth considering. And I'll end with a policy recommendation that we came out with in the pandemic, is that instead of having direct business loans through the Small Business Administration, it would be much better to have require firms receiving business loans to participate in the short-time compensation program to make sure that these workers actually remain attached to the firm. And I'm going to hold it right there.
Thank you very much, Till. It's been great to see the research that you and your colleagues are doing on these questions. I think they'll be really helpful for policymakers and practitioners. And speaking of which, I'm just delighted that Jim Hegman will now be providing us with reflections from his deep experience with shared work and with UI more generally. Jim is Director of Unemployment Insurance at Minnesota's Department of Employment and Economic Development. So thank you, Jim.
Great. Thank you, Ryan. Thank you, Leo. Thank you, Till. Appreciate this opportunity. I'm going to try to address this some sort of an administrator's point of view, as opposed to an academician's. So I was going to walk into this. I'm going to cover a little information that Aileen already talked about, but what I want to try to describe is sort of from our perspective, how we think about the toolbox that is UI, and how I'm going to try to get my slide to advance here, and how we get that to operate well for the whole program, but also to give us self-capacity for shared work. So I'm just going to cover UI administration generally. Aileen covered a little bit of this already, sort of how we address shared work administratively, and then a couple anecdotes, and again, cover a little bit of other information. So oftentimes it's not really clear from the outside that unemployment insurance is not really one program. It's actually a whole bunch of different programs that we sort of join together and make work and look like it's a single program. If you were to take apart our funding structure, depending on what we're doing at any one time, we're actually tracking probably 100 different programs at any one time from a funding perspective. So there's a lot of complexity in the background, and all this list of programs I've got here all interact with each other. So we're constantly moving people, especially when we're busy, between programs, and that gets quite complicated as sort of a management problem. A little bit of what I'm trying to introduce here is one of the challenges that states have when they introduce new policy things like shared work, is that they've got to take into consideration all of these various things they have to manage, and then try to successfully implement something new that might be conceived as quite different. As already been mentioned, unemployment insurance is what we call a federal-state partnership. So it started back in 1935. We're having our 90th birthday here in August. It is an eligibility program, and there's sort of rules with it that get pretty complicated. The technical terms we use is that we have to conform and comply with federal laws, rules, and regulations. This gets pretty complicated at different times, particularly if we happen to be in a recession mode and we're dealing with a lot of federal programs. One of the odd things about unemployment insurance is it's entirely workload based for administrative funding. So we get paid based on the number of items that we process, and those are extremely narrowly defined. So there's only certain things we can do, and that can create a challenge for states. Since it's workload based, when we're really busy, funding goes up, but also we're real busy. And then during the times when we're not as busy, that's good for everybody, but it also means funding's down, and sometimes creates challenges for administrators to try to adopt new directions for their programs. One of the things UI does is it generates a ton of data, and most of the data is really good, but I always just warn people that our data is administrative data. Administrative data is inherently kind of messy and sometimes means different things than what it would appear to for folks that don't do this all day. We are always in UI aware that most of the folks that we're trying to help are living paycheck to paycheck. So the single most important measure for any UI program is timely payment to eligible applicants. This is tough because we have to be able to scale up for whatever is going on in the economy. Minnesota is the most seasonal state in the country, so we have the biggest swing between our lowest point of the year, which is typically October, and our busiest point, which is typically January. And that's the biggest swing in the country. Typically, Minnesota has that. We also have to handle large layoffs and bring in the new folks if that happens without affecting the folks that are already in the program. Of course, we can't predict economic downturns. If we could, I always say we wouldn't be here. Downturns can increase activity levels by 2 or 3 times over our busy season. The pandemic, for us anyways, was about a 12-fold increase. Whole lots of new programs that we had to implement really quickly. We have to meet all of our performance standards, even though the workload doubles, triples, and so forth. And of course, it's not too hard to figure out that the workload is always going to precede funding. So the workload goes up before the funding goes up. Can't hire people until the funding's there. Then you have to train folks. And then by the time you get the training done and they become proficient, oftentimes you're done with the event. So in a normal kind of recessionary mode, by the time the funding comes up and we hire new staff, the actual event is over. It's never possible to really live with a backlog in UI. People simply can't make house payments. We do that. So that is never an acceptable sort of thing to do. There is no limit in the size of the program. UI is as big as it needs to be. And there's it's tough to staff appropriately. Technology and the business processes have to scale well. This is a lot of really hard work to do for those of us that administer the program. Don't want to kind of sound like a whiny bureaucrat, but it is not simple to do this sort of thing and to ensure that it scales to meet the needs of the public. So this is just Minnesota. Minnesota is a little smaller than Michigan, quite a bit smaller than California. This is from 2000, basically 2010. So this includes the Great Recession, and it passes through. This is just weekly requests, basic idea of how big the program is at any one time. And you can see the bounciness in the data. That's seasonality. That's Minnesota's seasonality coming through there. I don't know if you can see the mouse. I'm going to move this over here. So a little hard to see events sometimes, but all of these bounces are seasonality. That's seasonality over on the left side on top of the Great Recession. This is the pandemic passing through. So that's what a pandemic looks if you're curious. Looks like if you're curious. There's a little outie right here in the data in around 2011. That was actually a state shutdown. So we had a state shutdown. And at that point, I think we took 18,000 new accounts in 1 week, which was our record until we got over here during the pandemic. And then that record was eclipsed because we took about 100,000 more than that in a week. And I just want to say, it's a lot of work, but Minnesota scales well for those sorts of things. Not all states do, and so new programs and other challenges can be a bigger lift for them because of the complexities that they have to deal with. So not necessarily tough, a lot of moving pieces, all integrated, has to be integrated for it to work right, has to scale. We can't really build on spec. So when you're building new functionality in UI, let's say that you're thinking, well, we'd like to do shared work. You got to figure out a way to do that without kind of getting ahead of yourself too much. So best to do if you can integrate it in. All UI programs are incredibly technology dependent. The technology is tough. So being successful at it, I mean, Minnesota does pretty well in that area. But once you get a sort of a virtuous circle going, it's easier to move to the next thing. But sometimes states struggle with getting that circle going for a variety of reasons. So you want to get in front of the curve if you can, but that's not easy. So because we're mostly in front of the curve here in Minnesota, we were able to implement and integrate a shared work program. We actually did that back in 1994. So we've had it around for a while. We leveraged our existing technology. We didn't try to build a concierge or separate program. We didn't want to have specialty staffing that just did shared work because that makes those staff inflexible to work on other things. We're conscious that we wanted to keep the burden on employers as low as possible, not create a lot of overhead. We want to leverage the ongoing relationship. So for Minnesota, we do both the benefits program and the tax program in UI, and we're able to use the online application processes to allow employers to communicate with us a little bit more easily with data that we already have. We make a point of telling employers that the shared work plan is theirs, not ours. It exists largely to help manage morale. Usually all the workers know there's a challenge for the employer and they would like things to work out. As Till showed us, it's a better plan it's a better outcome for the workers if their employer can kind of manage a good transition. Most employers that we've dealt with are typically pretty happy with shared work, their shared work experience. Since you got to see some years of our regular program activity, this is shared work weekly requests passing through. You can see the early recession back in the early 2000s. And then you can see the Great Recession passing through, and you can see the pandemic passing through, and you can also see that we're a little busier on the far right-hand side of the graph than we were immediately after the pandemic. What we see in successful shared work plans is good pre-existing employer-employee relationships. Those plans where that doesn't exist are always a little bit tougher. Generally speaking, we'll see good human resources staff who are well engaged with the staff, supervisors, kind of the same thing. Most of the employers that have had things work well are employers who have talked a lot with their staff about what they're doing and why they're doing it. And this engages the staff in helping to get through the challenges that the employers are seeing. And those typically are plans that we've seen work out a little bit better. Some employers have used the shared work sort of intentionally to help transition staff over to define different work. So you might be able to use the single shared work day or shared work days inside the plan to help staff move forward. So shared work doesn't work real well for salaried employees because it usually requires a reduction in hours, and that's not typically what employers would do with salaried employees. They typically just want to cut the pay. It doesn't work well if the employees whose hours are reduced are key to recovering. So we've had employers have decided to apply the shared work plan to, say, their HR staff. That does not work really great because you need your HR staff to help manage the transition. If the employer is not doing a good job talking to the employees, then typically those plans don't work out particularly well. They might have a higher attrition rate, or folks just leave because they get dissatisfied for some reason. And sometimes they'll say, well, you know, you need to talk to UI about that. We don't know how that works. And that's fine. We're happy to talk to people, but then the employer is not really part of what the employee perceives as the recovery process. A kind of a relatively blunt way of saying this is shared work is part of the employer's plan instead of a plan. So you need to do shared work as part of your plan, not instead of a plan. So we have had employers who would kind of not want to have a full layoff, not quite sure what they want to do yet. So they might sort of desperately grab at shared work. Those typically, they might work out, but they might struggle a little bit too. So as Till said, during the pandemic, the feds actually picked up the cost, the normal employer cost of shared work benefits. They also provided what's called FPUC, so it's a supplemental payment to those applicants who are eligible for shared work. That supplemental payment was, at the beginning of the pandemic, actually $600 per week in addition to the shared work benefits. So if you had a plan that reduced you 1 day a week, you'd get paid full wages for 4 days, and then we'd basically pay half your wages for the day that you were off, plus you get an additional $600 on top of that. Later on during the pandemic, the supplemental payment amount was adjusted down, but it was still available. So the supplemental payment, the FPUC payments, were not prorated. They were at the full amount. As Till said, it's always been possible to do things other than shared work, and we see that all the time. Seasonal employers basically have hours that are sort of sporadic, so we can call those partial claims, if that's what you want to call them, at the beginning and end of the seasons. Work that's weather dependent regularly has partial layoffs during the week, and we see a lot of that here. We've also had employers that do what I'll call an alternating partial layoff, so 20% of staff every 5th week, for instance. So the cost of the employer is the same. And in some cases, it may be preferable to the workers. So we see that as well instead of shared work. Couple observations I would make is I actually think shared work is healthy for a UI program, gets our head in the right place sort of culturally, instead of being reactive, which is a lot of what we do. We're actually proactive. We're trying to help employers to manage a situation before people become our customers for the long term. For our approach to it, it scales very well. We were able to handle the pandemic without any problems on our shared work side, and we like that it keeps employers connected to our employees connected to their work and permits a transition to other work if necessary. A question that I would have is, does shared work cause a better outcome, or does shared work reflect a creative and engaged employer? What we have noticed in the past when we tried to do a sort of a rudimentary version of what Till did, we noticed that those employers had the best outcomes. Were also those employers that we thought were sort of engaged with their employees the best. So that's our observations. Thank you, everyone, for an opportunity to chat about this shared work.
This was great. And I just think it's crucial to have this sort of context for the quantitative analysis that was just presented by our previous speakers. I want to thank all of our speakers and all of you for tuning in. We'll make video of the event available soon on our website, and please be on the lookout for follow-up articles about short-time compensation, which we'll have in the coming months. And if you have questions, comments, feedback of any kind on this work, please reach out to me and our team in one of the ways that'll be described in the Zoom chat. And just have a great rest of your day. Thank you.